Welcome to the Explainer. So, NextPlat just dropped its latest earnings report, and honestly, the company is at a major crossroads. The numbers, well, they tell a pretty tough story. But management is out there promising a big comeback. The real question we're digging into today is this. Are we watching a smart strategic reset, or is this the beginning of a real stumble? Okay, so first things first. The moment the market opened on August 14th, this is how investors felt about NextPlat's quarter. The stock just plunged, down over 10% on some really heavy trading. You know, this wasn't just a little dip, it was a loud and clear signal of no confidence from the market. So what on earth did they see in that report that spooked them so badly?
All right, let's break it down. Two numbers just leap off the page here. First, revenue absolutely cratered, down a massive 22.1% from the same time last year. Ouch. And second, look at that gross margin. It got squeezed, big time. We're talking from almost 35% all the way down to under 22. Now, you might see that improved earnings per share and think, hey, that's good news. But, well, there's a little more to that story, as we're about to see.
To really get what happened with that revenue drop, you gotta look under the hood at NextPlat's business. See, this wasn't just one single problem. It was more like a perfect storm, with some really serious headwinds hitting both of their main divisions at the exact same time.
So yeah, the company was basically fighting fires on two totally separate fronts. On the healthcare side, which is their biggest segment, just about everything that could go wrong did. Prescription volume dropped, and key discount programs took a huge hit. And while all that was happening, their e-commerce business got absolutely slammed when a really critical service contract expired, causing their cost to just spike overnight.
You know, let's just pause on that 340B program for a quick second, because it's really important. Think of it as the lifeblood for their pharmacy's profitability. It lets them get drugs at a huge discount. So when the company comes out and says they're having issues with these agreements, that is not a small thing. It is a direct, painful hit to their costs, and it's a huge reason their margins just got crushed. And for the e-commerce side, the problem was just as fundamental. The easiest way to think about it is this. The basic cost to keep their services running just exploded. They had this great long-term contract that expired and bam, the new, much higher rates kicked in immediately, basically wiping out a huge chunk of profit from that part of the business.
But here's where the story gets interesting. While the top line and the margins were getting hammered, management was telling a completely different story on the expense line. And this, right here, is where the narrative really pivots, from the market's panic to what management says is their actual plan.
I mean, just look at the scale of this. They slashed their operating expenses from nearly $17 million down to under $5 million in a single year. That is a massive reduction. And this is the secret behind that improved earnings per share number we saw earlier. It wasn't about making more money. It was about spending drastically less.
So, you might be asking, where did all those savings come from? Well, it was a mix of things. Some were one-time wins, like getting rid of old merger fees. But the real story is in the deeper, more permanent changes. Reducing headcount, cutting salaries, and going back to vendors to renegotiate contracts. They were fundamentally changing how lean the company operates. Okay, so that's the damage report. But here's the thing. Management didn't just drop the bad news and walk away. Nope, they came out with a very specific, pretty aggressive plan to fight back. So let's take a look at their actual roadmap for a comeback.
And this was the line that really got everyone's attention. The CEO put a clock on it, 60 days. This wasn't some vague promise about the future. It was a public declaration to investors, basically saying, hey, hold us accountable. You are going to see real, tangible results within 2 months.
The healthcare turnaround plan really has three core pillars. First, bring in new people, new leadership to fix the day-to-day operations. Second, and this is a big one, regain control over their margins by launching their own in-house pharmacy to capture value they were losing to partners. And third, strategically pivot towards higher-margin specialty drugs. You can see how each step is designed to directly fight the problems we just talked about.
So, this all brings us to the central conflict of this whole earnings report. There are two totally competing stories that could explain what's happening at NextPlat right now. Is this just a temporary stumble before a big strategic reset?
Or is it the beginning of a deeper, more structural retreat?
And this really puts those two competing narratives into sharp focus. On one side, you have the bears. That's the market's view. They're looking at the wreckage of the present moment, collapsing revenue, shrinking margins, and a stock price that's even in trouble with NASDAQ. But on the other side, you have the bulls. That's management's view. And they're telling everyone, hey, look at the foundation we're building for the future. Incredible cost discipline, a solid 16+ million in cash, and that very clear, very actionable 60-day plan.
So ultimately, this is the entire story in one question. Is all the pain from this quarter just a transitory reset, a necessary strategic pivot before the growth comes back? Or is it the beginning of a long-term structural retreat for the company? Management has promised answers, and like they said themselves, the next 60 days, well, they're going to decide everything.